Hi, Andy, Joe, and Big Al. I've been listening to your information and entertaining podcast for the past year. I'm not sure that I've heard this exact question, so I thought I would give it a shot at getting this question, and it's answered on the air. Okay? Well, here you go, Jerry. It's your lucky day. Let's assume a married couple has retired and their only income is from their brokerage account consisting of $35,000 in qualified dividends, $25,000 in interest in non-qualified dividends. Additionally, they have $50,000 in long-term capital gains from their brokerage account that can be managed annually. The math is pretty straightforward to determine the amount of taxes owed and how much of the long-term capital gains are taxed at 0 versus 15. Yeah, math is pretty clear. Jerry, he sees a CPA on the side or something.
Yeah, he may be an advisor, and this is his client.
Exactly. I mean, he's got qualified, non-qualified dividends. I mean, no one knows the difference between a qualified dividend and a non-qualified dividend, and especially how a non-qualified dividend's taxed.
Plus, when it starts with, let's assume a married couple, meaning I've got a client.
Jerry, I have a client. And this is their tax return. The math is pretty simple.
Yeah.
I mean, everyone knows this. But here's the question.
What do you think?
Oh, boy. What happens to the income stacking for capital gains if Roth conversions are also done in the same year? Can I assume that the Roth conversions are added to the $60K for qualified dividends, interest in non-qualified dividends prior to the long-term capital gains? And therefore, if I do a Roth conversion of $100,000, that I'll not be able to take advantage of the long-term capital gains being taxed at 0%, giving the numbers above. Thanks in advance for your help, and thanks for YMYW podcasts. Okay, Jerry. Yes, we've written a white paper on this. Or Jerry's clients. If you did. So long-term capital gains sits on top of ordinary income. So a Roth conversion creates ordinary income. So the long-term capital gain would sit on top of that. And if you do $100,000, assuming no other income, if you do a $100,000 conversion minus the standard deduction of, let's say, $25,000,
sure.
Now you're at $75,000.
Yep.
Okay, so you're right at the difference of $5,000 in the 12% tax bracket. So $5,000 would be tax-free. But you have non-qualified dividends in interest in others that is pushing you above that. So your long-term capital gains then now would be subject to tax.
They would. And so if I look at Jerry's numbers, the income's about $110,000, standard deduction being about $25,000, so taxable income $85,000. So then, Jerry, either you or your client is now in the 22% bracket, so any Roth conversion is taxed at 22, but since Roth conversions come first, ordinary income comes first, it fills up the lower brackets, and so therefore you're not only going to have to pay ordinary income taxes on your Roth conversion, now all of a sudden you're going to have to pay 15% taxes on the capital gain. So just be aware of that. It's actually a different tax rate. You have to be careful when you have long-term capital gains that are taxed at 0. If you have enough Roth conversions to push it up, not only is that Roth conversion going to be taxed at 12%, but now that capital gain will be taxed at 15.
Versus 0.
Right, versus 0. So now you're actually in a 27% bracket without realizing it.
So, again, long-term capital gains sits on top. So anytime you're doing tax projections or calculating things for your client, Jerry, figure out your ordinary income first. And then you put the capital gains on top.
And here's your safest bet, rather than asking us, is get TurboTaxed and do one with and without and see what happens, and you'll see what I'm talking about.
Okay, thanks a lot for the question.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.